to the Campus Activewear Limited Q1FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Before we proceed on this call, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our businesses that could cause further results, performance, or achievements to differ significantly from what is expressed or implied by such forward-looking statements. The Campus Activewear management team is represented by Mr. Nikhil Agarwal, Whole-Time Director and CEO, Mr. Sanjay Chabra, CFO, and Mr. Piyush Singh, Chief Operating Officer, Mr. Krishna Kumar, AVP Investor Relations. I now hand the conference over to Mr. Nikhil Agarwal, Whole-Time Director and CEO, for his opening remarks. Thank you, and over to you, sir.
Thank you very much, Seema, and welcome everyone for joining our Q1 FY24 earnings call today. Campus Activewear adeptly navigated a challenging market landscape, registering a 4.8% YOY revenue growth at INR 353.8 crores. In terms of volume, the company sold 5.6 million pairs in Q1 FY24. The ASP in Q1 FY24 stands at INR 629, vis-a-vis 604 in Q1 FY23, registering a YOY growth of 4.1% in ASP. While the trade distribution has degrown by approximately 5.5% on account of higher base due to lower primary uptake on account of channel partners, our D2C channels, D2C online and D2C offline, has delivered growth of 10% and 82% respectively on YOY basis versus Q1 FY23, supported by sustained secondary consumption by the end consumers. The company continued its premiumization journey through new product offerings and enhancing its retail footprints in new geographies. The Indian sports and leisure footwear is a sunrise industry, with sports and fitness quotient grabbing a significant mindshare amongst consumers across India, including metros, Tier 2 cities and hinterland areas. Campus Activewear is well placed to satiate the evolving consumer demands and create value for its stakeholders in the coming years. With its robust business model, laced with vertically integrated manufacturing ecosystem, growing omni-channel presence, premiumization focus, product diversification across product segments, and categories backed with strong balance sheet positions. I will now hand over to our Chief Operating Officer, Piyush Singh, for his remarks. Thank you.
Thank you, Nikhil, and greetings everyone for attending this call. We are content to say that demand scenario is gradually improving, with Q1 FY24 delivering mid-single digit growth vis-a-vis the last quarter and the same quarter last year. While we are witnessing green shoots of recovery predominantly in the eastern belt of UP and parts of Bihar, we expect a full-blown recovery with the onset of festive season itself. During the quarter, our D2C business continued to demonstrate robust growth of more than 20% on a YOY basis. Our trade distribution business has narrowed the degrowth gap and is expected to get back to the growth trajectory in the upcoming festive season. With resurgence in demand in the Tier 2, Tier 3, Tier 4 and semi-urban centers, we are already seeing early signs of that recovery happening in some parts of the country. Basis price segments, our sales trend in Q1 FY24 has exhibited sustained premiumization, wherein sales contribution from semi-premium and premium categories have increased to 72% as against 68% as witnessed in Q1 FY23. Similarly, on a category basis, revenue mix across men, women and kids have stayed at 80-20 in the current quarter, driven by our continued focus towards growing these categories. The company benefited from favorable channel mix, product mix, and sourcing efficiencies, which results in a material improvement in material margin from 49.6% in Q1 FY23 to 53.4% in Q1 FY24. Subsequently, the gross margin has also shown substantial improvement from 36.6% in Q1 of last year versus 39.2% in Q1 of FY24. We'll continue our planned investments towards brand building, D2C network infrastructure expansion, and talent acquisition, which is key to our growth in the coming quarters, all of which is expected to generate margin accretive impact in the subsequent quarters. We are confident of restoring our trendline growth trajectory and margin profile in the coming quarters. I'll now hand it over to our CFO, Mr. Sanjay Chhabra, to take you through more details on the Q1 FY24 performance. Over to you, Sanjay.
Thank you, Piyush, and good evening and welcome everyone on board. During the quarter, our revenue from operations grew by 4.8% on a YOY basis to around 354 crores. EBITDA stood at 66.4 crores versus last year 62.2 crores. EBITDA margin stood at 18.8% versus 18.4% last year. Net profit during the quarter stood flat at INR 31.5 crore and PAT margin stood at 8.9% in Q1 FY24. On the balance sheet side, our net debt stood at INR 135 crores, which is a reduction of roughly 22 crores versus March 31, 23, wherein it was 157 crore. Net debt to EBITDA ratio stood at 0.5x in Q1 as against 0.6x in FY23. So our balance sheet demonstrates the position of strength with robust return ratios such as ROCE and ROE of 23.5% and 22% respectively as on 30th June. With this, I'll conclude and hand it over to the operator for questions and answers. Thank you.
Shall we begin with the Q&A session, sir? Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. We take the first question from the line of Ashok Srivastava, an individual investor. Please go ahead, sir.
Hi. Thanks for taking my question. And I really appreciate the management, the way you can see the recovery happening in the market. If I compare the same with other peers, we are in a pretty good
I'm sorry
situation.
to interrupt you, Mr. Ashok. Sir, are you on a handset or a headset?
Okay. Let me...
Please switch to your headset. We are unable to hear you, so please.
Am I audible to you right now?
Yeah, please go ahead.
Hello?
Yes, sir, please go ahead with your question.
Yeah. So, first of all, congratulations to management for providing a good set of numbers. And if I compare the same with other peers, it seems to be in a decent stage where we are right now. Only 2 questions from my side. As a retail investor, I just wanted to know that I stay in Delhi and I have visited to a lot of stores, the physical stores. And I can see that there is a much more time. People or means the demand as per what we are expecting from campus is not there. Means buying, is it happening because of the older stock which is still going on? Because I'm quite young and I have a lot of friends whom I used to discuss about the feedback of campus and Bata. So what I am getting a pretty much feedback that in campus store, whenever the youth, which is aging between 25 to 35, they go to stores, but they do not find a trend which is going on in the market. So whether the demand slowdown is happening just only because of cost of raw material or is it because of designing of the products? This is my first question.
Hi Ashok, Nikhil here. No, we actually take pride in, rather one of the biggest USPs of our brand is the fashion forwardness and the way we bring the latest design, latest trend, latest color palettes across the world to India first in the most cost efficient manner and the most price sensitive manner for a consumer set. So, we actually, like for example, the sneaker range that we've launched. So this is a very trendy range. And similarly, we launch about 300 new designs every year, along with an existing portfolio of 300 designs. So in total, at any point of time, we would have a portfolio of 600 designs. This is by far the largest portfolio of designs across any sports company, be it multinational, be it Indian. This is by far the largest portfolio. So, I would just like to say that, we are totally committed to providing the best value for money products and the most fashionable and the latest designs and technologies to our country first here, before anybody else. And that's the USP of Campus that we bring to the table.
Okay. Thank you so much for answering my first question. And my second and last question will be, when management is eyeing that we are going to the pre-IPO operating revenue front of side, means EBITDA margin and everything, when we are expecting to return back, seeing the current scenario? Yes, we are pretty much aware that there is inflation in cost of raw material and everything, but what exactly management is perceiving and how we are going to hedge all those things in future? Because if we see the economical scenario, which is demographically happening throughout the world, the Russia-Ukraine war is going on and everybody, but still, that's the quality of management, that what exactly you people see, that in how many quarters, in next upcoming quarters, when we are expecting to get the exact operating leverage or operating margin which we are receiving pre-IPO kind of a thing.
Hi Ashok, Piyush this side. Great question. So let me just apprise you that while we refrain from giving any future-looking guidance in this matter, but directionally we can assure you that on a pre-IPO basis or just after the IPO, our margin was trending in the range of 19.5% to 20.5%. That's the kind of 1% trajectory we typically follow as of now. As you can see in the current quarter, our EBITDA margin is close to 18.8%, which is in close vicinity to our long-term trending trajectory. While the endeavor is to improve this with the help of operating leverage in times to come, we can assure you that with an improving macro scenario and with all the input matrices that we have worked on over the last few quarters, we'll very soon be in the same trajectory as you expect us to be. The same numbers that we kind of entered the market during, especially on the margin side, with the IPO. So we are not very far off from that set of numbers.
Sure. Thank you so much, sir, for answering my question. And only if I can ask you last very small question, when we are expecting Challenger branch to get launched? Because in last con call, I think we had a discussion regarding the Challenger branch, which will be sub 1,000.
We had that discussion. We have a particular strategy in place that we are still testing it out in the pilot phase. As you rightly said, it's going to be a Challenger brand. It has a certain specific objective in place. The mothership will continue to be Campus. Our entire focus, management bandwidth, and energy is towards this flagship brand only. Challenger brands serve a certain purpose, and let's not get too carried away with the Challenger brand concept, because the whole the entire growth and the entire build out and the entire outlook is based around Campus for us as a management, as a platform.
Sure. Thank you so much, sir. Thanks.
Thank you. The next question is from the line of Mehul Desai from JM Financial. Please go ahead, sir.
Hi Nikhil. Hi Piyush. Thanks for taking my question. First question on gross margin front. Now, how do you see this trajectory sustaining in coming quarters? Do you see this kind of gross margin sustaining, or is there any kind of one-offs in this? And also, typically the second half margin, my understanding is second half margins are better than first half. You see that playing out given that you already have a very strong margins in the first quarter. So is it fair to assume that second half can be better than first half in terms of margins also? And related to gross margin also, given that you have certain benefits now, will you look at some pricing corrections to drive volume growth? Yeah, that's my first question.
Yeah, hi. Again, great question. On the margin side, So if we have to dissect this entire thing, this improvement in gross margin is actually driven by three important factors, which is favorable improvement in channel mix, favorable improvement in product mix in terms of sell-throughs, and again, sourcing efficiencies that we have kind of realized over the last couple of quarters, which we had already discussed in our previous commentaries. Now, just to answer your question around the sustainability piece, there are no one-offs in these margin improvement, but at the same time, this margin improvement is kind of linked with the growth profile that the company and the team is able to demonstrate quarter after quarter. Now, prima facie, our first half of the year is slightly lower on the margin side empirically because of a relatively higher mix of open footwear, which is pivoted towards relatively lower margin compared to the closed footwear, which is our forte so far. So as we enter deeper into the season, we believe that we do have an opportunity to improve this margin profile further. There could be a one-off in a month or so, depending on the unpredictable macro. But I can assure you that as a team, we are very much focused on improving and correcting and optimizing all the input matrices that goes towards margin improvement. See, macro is something that is out of control, but at the same time, our endeavor is to ensure that whatever is within our control, we should optimize that and pass on the benefit to all the stakeholders from here on.
Sure. And on the ASP front also, how do you see ASPs then moving? Given would you like to pass on some benefit, or do you think this 2 to 4% kind of ASP growth can sustain?
So again, if you notice that we have very reasonably priced our portfolio. The pricing is very, very sharp so far as a brand in our category is concerned. We have shied away from the temptation of increasing pricing, some of our competitors over the last few quarters. That's the sole reason why we have sustained the momentum, and people have kind of rewarded us with whatever little growth in a difficult macro that you can expect of. As of now, while we haven't taken any price increases which are unreasonable in nature, we don't see any opportunity, or we don't see any kind of a scenario where we would be taking any price cuts as of now. The portfolio is very sharply priced, and this has taken care of all the permutations and combinations and the scenarios wherein a certain growth has been baked in at this pricing.
Secondly, on this B2C online business, this 10% kind of growth, how do you see this? Don't you think that's? Are you targeting a much higher growth? This business obviously in 4Q had some issues. How are those issues now largely normalized, and how do you see trajectory for this B2C online business?
See, so far as the robustness of the business is concerned, we see absolutely no concerns around the sustainability of the growth profile of this particular business segment. Yes, there were certain issues in quarter 4 for which we had to reset. We have recalibrated, and in the coming quarter, especially with the onset of festive, we see this business getting back to the prime of its growth. So from a full year growth perspective orientation, the business is very much on track.
Understood. And lastly, on any comment on working capital? How is it versus March?
So fine, our DSOs, as far as working capital is concerned, there is a slight increase in investment in working capital, but our DSOs are very much in line with both March and last year's same quarter. What we see is a slight increase in the DPO, which is a good contribution, and with a subdued or muted demand scenario, we are sitting on some inventory, but we take that as we will leverage that investment in inventories in the upcoming festival season, and that would help us to sort of push more volumes in the market.
Sure. Great. Thank you so much, and good luck for coming quarters.
Thank you so much.
Thank you. The next question is from the line of Harsh Shah from InCred Capital. Please go ahead, sir.
Yeah, hi. Hi, Piyush, and hi, Nikhil. Thanks for taking my question. Very impressive margin performance this quarter. And given that there are no one-offs and a seasonally weak quarter, and I mean, that's good margins. So I just wanted to understand one thing on margins from a medium to longer term perspective. Now, if given the current quarter's performance and as we go into the second half where we have much better margins both at cross level and the benefit of leverage paying out, aiding EBITDA margins as well, I think that the 20% margin kind of guidance barrier can be broken very easily this year. But going ahead, let's say 3-5 years from now, how do you play this thing, right? Like kind of, do you want to keep the margins at 20% levels and invest whatever incremental margins you get behind to get more volumes and market share, or is the endeavor for us to kind of keep increasing our margins by, let's say, 50-100 basis points every year until we reach a particular threshold?
Yeah. Hi, Harsh. Nikhil here. So, great question, Harsh. Like we've also mentioned in our previous call, the end objective and the long-term objective for us as the brand is to make it the most number one top-of-mind recall brand in the country. And therefore, for a longer-term objective, we'll keep on investing behind the brand. So far, we've been investing about between 5 and 6% of our revenue in the ATL spends. And, we've grown this from about 3% to about 6% over these last 3 to 4 years. Therefore, we strongly feel that as the company scales up, we'll continue to invest behind the brand and we'll maintain the marketing spend at about 6% going forward as well. So therefore, in terms of margin accretion and the margin profile, we've certainly taken a number of measures to improve the margin profile that you see today. The one that you've spoken about earlier as well in terms of premiumization and the channel mix, and the cost savings that are now coming in. So we certainly believe that second half should lead to better margins in terms compared to first half. And in the long term, while we would refrain from giving you a specific guidance around the numbers, what we can tell you with surety is that the long-term objective of the company is to make the brand bigger and stronger. And in doing that, along with very, very good margin profiles, so we'll continue working on that objective. I believe that answers your question.
So, thanks for the explanation. So, basically, directionally, I'm not asking for a guidance, but directionally, basically, we do see the margins, some uptick in margins kind of as the business grows, right? Would that be a fair assessment?
Yeah, Harsh, Piyush this side, yes, that would be a fair assessment over a longer term horizon of say 4 to 5 years. Directionally, we'll be improving our profile from here on. But at some point in time, that's a balancing act we will need to play as a brand wherein, as Nikhil rightly mentioned, we will continue our sustained investments towards making the brand more robust, more likable and more reachable for the Indian diaspora out in the country.
Okay, got it. And the second question was more on the trade distribution part. The decline was 5% this quarter. So how would the split be for North and East, which is our core market, and versus the emerging markets of, let's say, South and West for trade distribution specifically?
While we have seen improvement in parts of core North India territories, which were earlier deeper into the woods, especially parts of Eastern UP and Bihar, they are gradually recovering, and hence we are narrowing the gap between say a growth profile and a slight degrowth here, quarter after quarter. West continues to do well for us, so does the rest of the country. It's just that some of the core markets in the northern territory, especially UP and Bihar, were not performing as per expectation because of severe macro downturn and people witnessing a K kind of a recovery in these markets, especially tier 2, tier 3 markets were very, very sluggish. They have started bouncing back, and with the onset of festive, the real hope is the macro would gradually improve, inflation will subside, and with more farm income coming into place along with the elections, we expect these markets to also bounce back.
Okay. No, I was just trying to understand the difference between the industry decline in North and East and our performance in North and East.
We have largely maintained the same performance because a 5% decline in value terms is somewhere in the vicinity of 10 crores here and there, which is like a couple of days of billing for us. So, directionally, we don't see any significant decline happening in any of the markets. It's just that growth is still elusive in some pockets. They are also gradually coming back, and with festive onset right around the corner in the coming quarters, we expect these markets to also come back into their full glory as previous years.
Okay. And could you offer any comments on how July and let's say just the 10 days of August were compared to June quarter?
I mean, we would refrain from giving any mid-quarter guidance. I hope you'll understand from that. I hope you'll understand because it's too early for us to comment on a quarter or a half-yearly performance, which is just a month's output. Still a long way to go. So we'll refrain from any guidance on that part right now. But we'll certainly come back to all our stakeholders once the quarter has gone by and the numbers are out.
Got it. Thank you so much, Piyush.
Thank you.
Thank you, sir. The next question is from the line of Yash from Sternberg. Please go ahead, sir.
Yeah, am I audible?
Yes, sir.
Yeah.
Yes.
Thanks for the opportunity. Our D2C offline channel is actually the fastest growing channel for the company today, with an aggressive addition of EBOs across India. So, wanted to understand what is the unit economics for a store, and how do you kind of get confidence in terms of the ramp up in the middle of, let's say, what you are putting out as a macro store?
Yeah, great question, Yash. So let me first add more color to it. D2C offline is a combination of our own stores, COCOs, franchisee stores, and a large part of it comes from e-accounts. So majority of this growth that you see in D2C offline, roughly to the tune of 82%, is driven by key accounts and franchisee stores, because now we are in a stage where we are not opening a lot of company-operated stores. Actually, this is the faith reposed in us by most of our franchisee partners, which are master franchisees for multiple states and who are witnessing the ROI-based proof in terms of the return on investment that they are generating on the current network, that they are adding their own capital to the scale-up. So, for example, some of the states like Gujarat, Maharashtra, Rajasthan, parts of, or you can say parts of Central India, they are doing better than average performance across retail. You can say retail spread across various other brands. So, it's in fact their investment which is coming into play right now. I hope that answers your question.
Understood. So, out of the 225 odd stores, how many would be company-owned stores?
So it's roughly 95 stores is a company-owned stores, and most of these stores are vintage stores. Over the last couple of years, franchisees have added roughly 135, 140 stores for us.
Understood. And incrementally, you don't plan to add...
We'll be moving ahead with addition of stores in a ratio of say 70-30 in the favor of franchisee to company.
Understood. And the other question is on the group meeting. You'd mentioned that let's say 22% margin EBIT is aspirationally a target. This is back in March, like few months ago. Want to understand what is going to be the bridge from, let's say, 14% odd today to achieving the 18, 20, and then 2022, that kind of EBIT margin from here on out.
I believe you are referring to EBITDA here, not EBIT, because directionally what we've been maintaining across our calls and investor interactions is while we are currently trending at close to 19-20% EBITDA, the idea is that over the next 3 to 5 years, we should incrementally add on to EBITDA margins like 1% accretively year after year for the next 5 years. I mean, there could be plus and minuses between one-off years here and there, depending on how the overall economic scenario is. But actually, that's what we are aiming at. And eventually, I mean, this is not a very capital-intensive industry. At some point in time, our endeavor is also to become debt-free. We should take care of the interest part. So we have a certain milestone so far as EBITDA is concerned, EBIT is concerned, PBTs are concerned. We are heading very much in that direction quarter after quarter. All the input matrices that are requisite for this kind of an improvement are very much in play. So the roadmap is very well laid out for us. We just need to focus and we have to stay disciplined, gain more market share in the current scenario, wherein people are going for down trading and some kind of postponement. Idea is to gain more and more market share and shelf space. Rest everything else will fall in place with the help of operating leverage.
And to some extent, we need the markets to sort of start back up again, by at full throttle.
Understood. And one question on, let's say, margins that you've reported. If I were to look year on year, it's broadly flat on let's say EBITDA and EBIT, but let's say we've seen a very sharp improvement in RM, which is gross margin, but that gets offset by something in the other expenses. Just want to understand, is it that we get higher gross margins in online, but since you report marketplace commissions and other expenses, that largely that benefit gets knocked out? So because you mentioned in the call earlier that gross margin improvement is because of product mix and channel mix. So just want to clarify that.
Yeah. So essentially, there are a couple of fixed expenses which increases year after year, which we all know, which includes employee expenses, some bit of ESOP expenses which have come into play, and our sustained investment towards advertisement and brand building. So these are primarily the expenses which has led to kind of flattish EBITDA margin on a year-on-year basis. While the improvement, as you rightly mentioned, is on account of favorable channel mix and the product mix, and largely on account of sourcing efficiencies that we have witnessed over the last couple of quarters.
Okay, so it's not that largest part of the increase in other expenses is coming out of marketplace commission. That's what I wanted to kind of confirm.
Not really. I mean, there is some increase in marketplace commissions because of the overall change in mix of online business, wherein we are moving more and more towards marketplace model compared to the outright managed marketplace fees. But that has already kind of contributed with the higher net realization in the top line. So it kind of, I mean, in a way, that increase in realization or increase in subsequent gross margin kind of takes care of that slight increase in commissions on account of marketplace sell-throughs.
Understood. And in terms of, let's say, how do we think about ASP going forward? Because frankly, there seems to be a certain price point within which, let's say, increasing the prices may kind of cause us to lose competitiveness on some of these platforms. So how are you seeing, let's say, your ASPs moving, let's say, 4 or 5 years out in terms of the growth rate, rather than a near-term picture? But can you move beyond this 600-700 rupee range if you were to grow at, let's say, the aspirational target of 20% plus or whatever number that you at least plan for?
Yeah. So, we see a good opportunity. Like, we've been growing our ASPs consistently over the last 10 years at about 6 to 7%. But going forward as well, it's not that we need to take a big MRP increases or we need to enter categories above 3,000. We do still believe we have a pretty big opportunity within the spectrum of 1,000 to 2,000 due to the channel mix and the premiumization that we'll be doing within these price points, 1,000 to let's say 3,000. So the market, and given that the BIS, the way it's coming in now, and it will be implemented from the 1st of January 2024, with a lot of clarity that is coming from the government so far. it will be the primary objective of BIS again is to deter and ban the imports from China, Vietnam, and Indonesia into the country. The similar way they've done it for the toys industry and tires and so on. So we are extremely excited about the prospects of BIS as well, contributing towards not just the growth and margins, but also towards this ASP increase, because a lot of the materials or the finished goods that's coming from China today are in this price point of 1,000 to 3,000, and a lot of that will be pretty much leaving the market very soon. So that's the way we are looking at ASP. So we are pretty much in that very sweet spot of 1,000 to 3,000 bucks. We really don't need to enter into 3,000 plus categories in order to increase our ASPs.
All right. Thank you very much for patiently answering my questions.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. We take the next question from the line of Vatsal Dujari from CLSA. Please go ahead, sir.
Hi, thanks for the opportunity. I just had one question. So how are we performing in the southern regions, and according to you, what the characteristic of the southern market makes it a little more challenging versus the other markets for us?
Hi, if I understood your question correctly, you are talking about our performance in southern markets. So we have pretty much held fort, maintained our market share in southern India market. So speaking about last 12 months, our contribution from North and Central India is close to 50%, 50-55%, with West India contributing roughly 23% of our sales, East contributing another 17%, and 16 to 17%, and South India contributing roughly 11.5 to 12%. So we have managed to gain traction in these markets. We are steadily gaining market share, and currently our mix is mimicking the industry mix of sports footwear all across the country as well. So we are truly mimicking the contribution mix of a pan-India brand.
Okay. Yeah. Okay, that's my.
Thank you. We take the next question from the line of Gaurav Jogani from Axis Capital. Please go ahead, sir.
Thank you for the question. The opportunity. My first question is with regards to, in case of, you have alluded that, you would be like to drive market share. So in that event, would you also be open, to maybe readjust the price and drive the volume growth in the near term? Because, we have seen increased competitive activity from many new players coming into the market, as well as the slower growth has pushed early versus also during the year.
I got a Piyush this side. Great question. Given quite a few set of folks are really interested in if we are going to give more discounts to drive volumes. See, the clear answer is our portfolio is very, very sharply priced as per the demand spectrum that we are currently witnessing in the market. So people are not actually looking for discounts. People are looking for the best value proposition, price value proposition, which we believe that within campus we are offering. We have never taken unnecessarily price hikes, so there is no question for us to drop prices in order to drive volumes. Volumes are still very much in place for us compared to rest of the industry or some of the other peers that you may be tracking. The sole reason is people believe that they are paying the right price for the product that they are getting within this brand, and that's the sole reason why they keep coming back to campus as their repeat purchase. So it's a very well positioned, well priced portfolio. We take care of our consumers at the very onset while pricing the portfolio itself. Hence, there is no such need of playing a high-low game wherein you first price the portfolio higher and then give a deeper discount. Let's not take consumer let's not try and feel that consumer is dumb in that sense. Indian consumer is very sharp. They understand the real worth of the product, and hence they are not really seeking discounts. They're seeking the right value for the money that they're paying.
Sure.
We believe the brand is really delivering.
Okay, sure. So my question was more, with regards to the competitive pressure, while your products are, very attractively priced, I would agree to that. Just that, because of the early onset of EOSS, consumer tends to seek more discount, and hence that was the question coming from.
So certainly, I mean, we have seen behaviors across our online and offline formats. While our online discounts have increased by a couple of percentage points, but then again, I would refer to some of the conversations without taking names with some of our platform partners, where they say that the sensitivity is so strong in campus that even a 1% drop in price or 1% increase in discount drive volumes, which other brands, even by discounting as high as 10% incrementally, are unable to drive. So that is the kind of price value proposition we drive by maintaining a very tightly priced portfolio and not discounting it unnecessarily. See, volume pressures are always there, ESS pressure is always there. Driving numbers is always there, and that's why as a management we maintain this spiel that you should always judge a brand or judge a platform by the strength of its portfolio or by the strength of its decision making capabilities during testing times. See, there is a lot of temptation. There's a lot of temptation that we can drive a lot of volumes by discounting, but that really rubs against the grain or the ethos of our brand. So we know what we have to deliver. We understand that fully, but at the same time, we don't want to dilute the brand unnecessarily just for short-term gains. And that's the principle that we all stand by.
Sure. Thanks for the detailed explanation. And my next question is just more related to the BIS implementation. We hear that a lot of these imports are in that price point of 1,000 and 3,000. If you can explain a bit in detail how this can benefit to the entire industry and campus especially.
Right. So, like I mentioned, BIS is aimed at curbing the imports from China and Vietnam and Indonesia, and these are the three nations from where the majority of imports of sports shoes is coming into the country. So naturally, once this entire volume, which is a very significant number, we believe that volume will sort of erode away. This will obviously open up, doors to not just campus, but pretty much like the entire footwear industry. And they should benefit, the Make in India campaign that our Honorable Prime Minister is encouraging all us to do. So that is the primary objective of this BI scheme. And on top of that, there were some clarifications also that have come in terms of, that earlier there was some confusion regarding the non-BIS goods. How much time will the government give to various companies and the channel partners to sell through all the non-BIS goods? So that clarification will also come in that by 31st December this year, every company and every channel partner will need to update their stock statement on an online portal of their non-BIS goods, and the government will give them adequate time to basically sell it off. So there is no, the government is absolutely looking out for the domestic players. They are making sure that nobody goes under, and this entire move is primarily aimed at just curbing the imports. So that is basically the gist of it.
So just one question here, would this restriction would also be on the soles or, those that are imported from China or the raw materials, or is it just on the finished goods?
No, it's only on the finished goods. But naturally, finished goods is sum of parts of your sole and upper and all the raw materials. So if the finished goods need to comply with certain requirement of BI standards, then naturally all the raw materials and the sole and all will also have to fall into place. So it just percolates down to the raw material as well in that sense.
So Gaurav, I mean there are testing parameters expected for upper material and sole material separately, like abrasion resistance and flexibility and things like that. So individual components cannot escape BIS regulations per se. In one line, if we have to summarize, BIS augurs well for a quality domestic brand, because ultimately the standards would be the quality standards would be uniform for all the domestically manufactured products, be it a 500 rupee issue or be it a 1500 rupee issue. That means there will be an enhanced pressure on local manufacturers who are cutting corners as of now, who are producing substandard quality just in the name of fashion. So the government wants to do away with that as well, along with cheap Chinese imports or cheap international imports. Idea is to ensure that Indian consumers should get the best quality footwear, and at the same time, India should gear up in the coming times to create world-class quality footwear, which is ready for exports as well. So that's the overall objective of the government, which really works well in favor of an established domestic brand, which is truly focused on quality.
So just one clarification on that. So because of this implementation, getting effected from the 1st of January, so in the interim period, do you expect any supply chain disruptions, just before the implementation of this, and because of which any stocking that you would have done?
Not for us, because anyways 90% of our sourcing is indigenized in nature, and we only work with high quality vendors who provide quality stuff. So nothing really changes in our lives.
In any case, I'd just like to also clarify that for a brand like Campus, we've always anyways adhered to the highest standards of quality. So even though the BIS standards are decently stringent, we pretty much fall into, I would say, from the previous legacy days also, we've been falling into these standards just by the sheer quality standards that we maintain. So we've been complying with BIS anyways, so it's not really
I mean, as an update, our testing labs are already been approved by the government. They are already in place. We are just waiting for the testing standards to be released by the government. The moment they get released, we believe that we'll be able to churn out BIS certified footwear in no time.
Sure, sir. Thank you. Thank you for answering my question. That's all.
Thank you. A reminder to all the participants to limit your question to 2 per participant. We take the next question from the line of Bharat Gyani from Money Control. Please go ahead, sir.
Yes, sir. Thank you for providing the opportunity. 2 questions from my side. One is in the presentation we have seen that you mentioned that in the trailing 12-month period our growth has been kind of a flat if I see the overall revenue growth. So what would you attribute this factor to? The overall industry slowdown, or have you seen a market share loss in the trailing 12 months? So that would be my first question.
Bharat, we have directionally gained market share. Given you cover the entire industry, you are very well aware of the fact that industry last year, all the segments put together, and specifically sports footwear, has only other segments have degrown. Sports footwear has grown in single digits. While on a trailing 12-month basis, we have maintained a growth rate of 24 to 25%, which is way above the industry standard. So this clearly implies that directionally we have gained market share across newer emerging markets where we have followed over the last 3 to 5 years, and at the same time we have kind of held the fort, maintained share in territories which have seen some bit of degrowth over the period in discussion. So clearly we have gained share, not otherwise.
Okay. And so next question is that while we have mentioned a lot about how the margin trajectory with over a 5-year horizon kind of will improve by the endeavor will to improve margins, but I guess the street is more concerned about the growth trajectory. So in the last trailing 12 months, as we have seen revenues getting impacted, obviously that is to do with the as you pointed out, that would be due to the market slowdown. But when do you feel that the campus will get back to its growth trajectory that we have seen pre-IPO, or if I may put it in the other words, over the next 4 to 5 years horizon, what's your revenue growth rate that you target?
Bharat, when we entered the market with an IPO, our 3-year CAGR, 5-year CAGR was somewhere in the range of 24 to 27%. We believe that last year also, FY23, if you look at, or trailing 12 months, if you're referring to, we have maintained that kind of growth trajectory. There have been some shift in the margin profile, but at the same time, we have maintained this that in a slowdown kind of a scenario, if we have to pick between the two, we'll still go after growth at any cost for right now with a respectable margin profile, because margins are easy to recoup in a stable macro. But at the same time, it's our endeavor to gain more and more market share, gain more and more shelf space, because that is something which is sticky in nature. Margins are easy to recover, but growth becomes elusive in competitive markets. So these are some pockets of opportunity. So we believe that slowdown is a blessing in disguise. These are pockets of opportunity wherein you get a shot at gaining more market share when others are actually not that much focused on the same activity. Hope that answers your question. See, we will very soon we'll get back to our standard margin profile. That's nothing to worry about.
Okay, sir. Thanks and all the best.
Thank you so much, Bharat.
Thank you, sir. A reminder to all the participants to restrict your question to 2. We'll take the next question from the line of Mr. Deepak from IGE India Invest. Please go ahead, sir.
Yeah, thanks for the opportunity. I would like to understand what gives us confidence to gain the market share further in future. What differentiates the things we are doing compared to the other players, and what's the market outlook here on? Are we behind the low growth situation from now onwards? The consumer demand is picking up, or like to have your views? Thank you.
Yeah, hi Deepak. So certainly we've experienced sort of a lull in the market in the last 12 to 14 months. This is an overall macro slowdown which every single footwear manufacturer has experienced. But going forward, we believe due to many reasons that it's been a good monsoon this year, the festive season as well, and the elections also coming up very soon. We believe that H2 second half of this year should result in definitely better demand along with margins, complementary margins, and even going back to the company basics. Campus, the biggest USP, we have 4 pillars on which we take pride. Really, one is the largest R&D in the country, the most developed number of designs that we churn out, the latest trends. The second is the largest vertically integrated manufacturing ecosystem that we have. So nobody is even close to the kind of capacity that we can produce, which is about 35 million pairs of capacity every year. And third is our entire omni-channel platform, where we have the largest integrated sales ecosystem between online and offline, and lastly being the most innovative brand marketing techniques that we've used and the strategies that we followed, and which have resulted in significant appreciation of the brand in the last 2 years. So given these basic concepts that the brand sort of hinges on, we have seen very, very, very decent growth over these last 10 to 15 years. And there is no reason that should not happen going forward as well. We just need to stick to the basics, and we're keeping it simple.
Any new category of product apart from sports shoes which we are planning to enter like the other competitive player? And
launched a very exciting sneaker range along with our sports shoe ranges, and we'll keep on beefing our casual footwear category, because we see a lot of potential in that category along with the sports shoe category that we currently champion. You'll see something really refreshing, really exciting in our current offering in the autumn winter season. Currently our trade shows are going on. signs are very encouraging. You'll see a lot of refreshing ranges, both in the sports shoe category and the sneaker category, coming your way in the next couple of months.
Okay. Thank you. Wish you all the best.
Thank you so much. Thanks.
Thank you. We'll take the next question from the line of Manish Dhariwal from Fluida Capital. Please go ahead.
Thank you very much for this opportunity. Now, actually, I'm new to the company, and so I have some basic questions. So, one is that does the promoter family have any other businesses other than footwear business?
No, we don't. The promoter family is completely vested into only this business.
That's wonderful to hear. And secondly, has the promoter group reduced their stake in the recent past?
No, we've not.
No, they haven't sold even a single share since
There has
IPO.
been no change since the IPO, not even a single share.
Okay, wonderful. The last thing is that, I've observed that, like the premiumization and everything is like, I think it's very good to hear. But then why is it not getting reflected in the ASP? See, ultimately, if I'm selling a premium product, then I'll be able to secure a better price, which will reflect in my ASP. So that actually is not reflecting. So if you could just help me understand that bit.
Yeah, hi. So, there is sustained improvement in that ASP. If you look at our 10-year CAGR, the ASP is improved by 7%. So what you see at the store is a maximum selling price, maximum retail price, MRP. Company gets only a part of it. The rest of it goes as taxes and channel margins. So if there is say 10% increase in our MRP year after year, you will see only 4 to 5% of it reflecting in our ASPs, because that's what the ratio of MRP to ex-factory is for a brand like that. So we are predominantly a distribution-oriented company, wherein our channel margin is wherein our company margin is close to 50%, roughly 35-40% goes to channel, and the remaining goes as taxes. So if 10% price increase is there or premiumization is there, half of it will reflect in the ASP, and that's kind of the simple alignment between our numbers and the products that you see out there in the market.
Thank you, sir. A reminder to all the participants to limit their question to one per participant, as we have several participants waiting for their turn. We take the next question from the line of Ashish Gupta from Goldfish Capital Advisors. Please go ahead, sir.
Hi, just one input from my side. Could the management please include, the subcontracting charges separately in a panel in your investor deck, so that we get a clearer picture of the gross profit margin per quarter? That will be very helpful to understand. Since it's close to 5 to 6% of your revenue, the subcontracting charges, which is other expenses.
I mean, while we hear you, I mean, some of these are the company level IPs, because it will eventually give away the kind of arrangements, exclusive arrangements that we have with our network partners. While we hear you, but this is one information that we won't be able to.
Anyways, you're giving it in your annual report. That's the reason why, since it comes in your annual report, there will be a problem coming out in your quarterly decks as well. It's just a number.
So we hear you. I'm sure we'll take this into consideration. Thanks for highlighting that. It's anyways part of the annual report.
Yes, thanks.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to the management for closing comments.
Thank you so much, everyone, for reimposing your faith in Campus. We are extremely delighted to share this set of numbers with you for Q1. And going forward as well, we assure you that, Campus is in the best, well-placed position, along with a lot of these external factors that are also giving tailwinds to the brand, like the BIS coming into play and the onset of festive season. So we're looking forward to a decent and a very good second half of the year.